Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Adelina Safitri. My NPM is 2441109. I'm from manajemen class 24A. So today, we're gonna talk about the material of capital structure analysis, comprehensive explanation. In the first slide, we're gonna talk about the introduction to capital structure. So what is capital structure? So capital structure refers to the mix of debt and equity that a company used to finance its assets, operations, and future growth. The composition of this financing mix plays a crucial role in determining the company's risk profile, profitability, and long-term financial stability. So a well-designed capital structure allows a company to minimize its cost of capital, maximize firm value, and maintain sufficient financial flexibility. Therefore, capital structure analysis becomes essential to evaluate whether the company is using an optimal balance between debt and equity. Okay, second is components of capital structure. So the first is equity financing. So equity financing represents ownership in a company and can come from common stock issuance, preferred stock, and also retained earnings. And equity financing does not require fixed payments, making it less risky than debt. However, it might dilute ownership and often involves higher costs due to shareholders' required return. And debt financing, debt refers to borrowed funds that must be prepaid, typically with interest. It includes like bank loans, bank payable, and also not payable, and the last is leaves obligations. So debt allows companies to use. Okay, next is we're gonna talk about structure analysis. So capital structure analysis involves several fundamental concepts that help financial managers evaluate the impact of financing decisions on the firm's value, risk, and performance. This concept provides a deeper understanding of how the combination of debt and equity influence a company overall financial health. First is leverage. So leverage refers to the use of borrowed funds, debt, to increase the potential return on equity. A is a company that effectively utilizes leverage can improve profitability because debt financing is typically cheaper than equity. However, leverage magnifies both gains and losses. We have a positive effect. So the positive effect is in favorable conditions. Leverage increases returns on equity, ROA. Equity because the firm earns more from the borrowed funds than the cost of interest. And also we have a negative effect as in downturns high leverage increases fixes financial obligations, raising the risk of financial distress or bankruptcy. Therefore, leverage must be managed carefully to ensure the firm does not become overly dependent on debt. Okay, last is cost capital. The cost of capital represents the return required by investor, both debt holders and equity shareholders. It is a critical concept for evaluating financing decisions and investment feasibility. Capital structure directly affects the weighted average cost of capital. Like more debt, reduce VACC in initiality because debt is cheaper and provides tax deductibility. As excess debt is increased VACC due to higher perceived risk from creditors and shareholders. And a company aims to achieve the optimal capital structure where VACC is minimized and firm value is maximized. Okay, that's all about my presentation about my material. I hope you guys understand. Don't forget to like and subscribe. Assalamualaikum warahmatullahi wabarakatuh.